Welcome and good afternoon. My name is Doug Lean. I'm Manager for Economic Development for the City of Auburn, Office of Business Development. And welcome to a continued offering of our business workshops that we produce every month for new businesses and existing businesses to hopefully get information that will be helpful to you on an ongoing basis in developing and expanding your business. Today's program is going to be focused on finance, legal, and accounting issues. This is geared towards drilling into a lot of detail. So our presenters are going to give you a lot of hands-on information that hopefully you'll be able to put in practice and give you some thoughts and help you through the process of being successful in your new venture or expanding your existing business. I would like to say thank you to Mayor Nancy Backus and the Auburn City Council for their continued support and financing that brings this programming to our business community here in Auburn. Our first speaker is going to be Mr. Dan Shin. He's an attorney at law. He's an Auburn resident, and he's going to talk to us and present on the subject of starting out on the right foot. Dan?
Okay, thank you for inviting me. I'm an Auburn resident. I live in the Lakeland Hills area. We love the city of Auburn. We moved here because Doug has been revitalizing the downtown. He convinced us to move here, and we've been here for about half a year. I work up in Bellevue. I work with startup companies, companies that are expanding, companies that are selling or refinancing. So I do a lot of transactional work. If you see me around, usually something good is happening. I'm not a litigator, so when you see me around, it's usually a good story. There are 5 common types of legal entities for small businesses: sole proprietorships, general partnerships, limited partnerships, corporations, and limited liability companies. There are other types of entities that we won't be covering today, such as nonprofits and social corporations. But these are the top 5. And to cut to the chase, my favorite is number 5, limited liability company for most small businesses. If you are a tech startup and you're hoping to have angel investors, a whole group of shareholders, you want to have a corporation. You never want to be a sole proprietor. You never want to be a general partnership, and we'll go into why. You're going to be one of the 3, number 3, 4, or 5. There are 3 common factors to consider when choosing which type of entity you want to form. Number 1 is it easy to use. As a small business owner, you're extremely busy. You're building your business, your services, your goods. You don't have a lot of time to mess around with all the paperwork, all of the record keeping, the administration, and compliance. So that is one factor to consider. Also, if you have a business and you're the sole owner, you want your paperwork very thin and easy to use. If you have a lot of partners, if you have a lot of shareholders, then you need a lot more sophistication, and the corporate structure might be better for you. Second factor is personal liability. The 2 entities that we recommend not using have a lot of personal liability. If you are a sole proprietor, which means you're operating your business under your own personal name, you are completely vulnerable. Everything you own, everything that you own with your spouse, 50% of your community property is vulnerable. So you should never be a sole proprietor, never be a general partnership. And third, tax implications. Different entity structures will have different tax implications, and we'll touch on those as well. First, we're going to go through ease of use, sole proprietorships. Sole proprietorship is just you as your own business owner. If your name is John Smith, it's John Smith, Accounting Services. It's easy to set up. There's nothing involved. You just apply for your business license. It's easy to use. You don't have all of the reporting requirements of a corporation or an LLC. The nature of it is that it is you. You are your company. There's no separation. There's no distinction. There's no asset protection. To form it, you don't have to register or file anything with the Secretary of State. You have your regular business license application, which you can do online. For maintenance, you just have your regular reporting and tax implications, your B&O taxes, excise taxes, payroll, regular business reporting. For property, all the property, you own it yourself. You're the 100% owner. For control, you control it yourself. Allocations of profit, losses, your salary, that's all you. Transactions are very simple. When you sign in your personal name, and if you're buying a piece of real estate, your spouse would also sign to tie up the community property. So easy to use, and that's kind of the default for a lot of small business owners. Do not do that. Don't do that. Number 2, general partnerships. This is also kind of a default when you have 2 or more people putting together a business or selling goods together. General partnerships are governed by the revised Uniform Partnership Act, RCW 25.05, and that's on the internet. Nature of it is 2 or more people carrying on a business for profit, and the partnership actually becomes a distinct entity, separate, with some separation from the partners, but not enough for my comfort. Formation, you don't have to register it. You don't have to have a partnership agreement. You can file a few statements with the Secretary of State, and this is in regards to establishing for the public who has authority or who does not have authority to bind the partnership. So these are statements of authority, denial, dissociation, and dissolution. So if you have a partnership, if you've ever had a partnership, you need to file a statement of dissolution. You need to make sure that it's closed. Just the fact that you're not actively doing the business anymore doesn't close your business. You need to file a statement of dissolution. What that does is that puts an end to any liability. Your partner could be binding you to contracts you have no idea, and they skip town, and suddenly you're in the middle of a lot of litigation. Yes? Is that filed with the Secretary of State? Yes. And it's all online. They have standard forms on the Secretary of State website. If you Google it, it's very user-friendly. Partnership agreements can override the statutory default rules. So in Washington State, we have some default rules regarding partnerships. We have some basic rules. You can override most of those rules with a partnership agreement. The agreement is just a set of rules of how you're going to conduct your business. Maintenance is easy. You don't have to have formal meetings. You don't have to keep minutes. You do have to keep your financial records and any reporting requirements. You have to give that access to all of the partners. But there aren't any records that you send to the Secretary of State that's required. If you buy real estate or you operate a business, it's owned by the partnership, not each of the partners. And this is the part that is scary. Every partner who is operating in the ordinary course of business can bind you legally to contracts. They can get you in trouble if they make mistakes. You are vulnerable. So your partner is like a clone of you. Whatever they do, you're on the hook for it. If they skip town, you're holding the bag. Default rule is each partner has the equal management right. If there are, let's say, 3 partners, majority rules, if 2 decide, yes, we're going to go forward with something, the majority rules. There is a duty of loyalty and care to the partnership, so they can't, you open up a teriyaki shop and then you have a fight, and then right across the street you open up a rival teriyaki shop. You can't do that. So there are some general rules about fairness, good faith, fair dealing. Allocations, again, default rules are you share equally in your profits, your losses. Your tax basis is based on your contributions, share of profits and losses that accumulate, your debt. You don't have a natural right to a salary, but you can agree on that. When you do transactions, banks will probably require you to have a partnership agreement because they want to see who's authorized to sign the documents, or at least an affidavit, an indemnification of the bank saying, these are all the partners, everybody signed, these are all the spouses, everyone signed, it's authorized. Partnership interests are considered personal property, and you can sell them. So if you had a partnership of 2 and you don't have a partnership agreement, you have the right to sell your share. But the existing remaining partner by law does not have to accept the new partner. What they do is they take that person as a passive or like an equity investor. And then this can cause a lot of fights. Limited partnerships are governed by the Uniform Partnership Act. Oh, I'm running out of time already. I'll speed it up. Limited Partnership Act, RCW 2510. It's a distinct entity. You do have to register with the Secretary of State. You file a certificate of limited partnership. Limited partnership agreement is not required, but I highly recommend you have one because that will state what the rules of the company are. You have fights when you are not clear how you're going to run the company. Fights happen when there's miscommunication or assumptions. And when you get into a partnership with someone, it's like a marriage. If the expectations are not clear up front, you're going to have fights. Even family members, brothers and sisters, best friends. We have lawsuits involving family members all the time. You have to have a good agreement, make it clear, make the rules and expectations clear. In your name, you have to have LP, L.P, limited partnership, to make it clear to the public that this is a limited partnership and the people who are running it, the limited partners, are not personally liable. So when you enter into a contract, the limited partners are not liable. In an LP structure, there's the limited partner, so they're kind of like the passive investor. They're not actively involved. And then you have a general partner. The general partner is the one who runs the show. They're in charge, and they are liable. So in most LP structures, you have a general partner, but that general partner itself will be a limited liability company rather than a person. And the reason why is no one wants to be on the hook. No one wants to be liable. Limited partnerships are not too common. I see them in EB-5 foreign investment project structures where you have a general partner who runs the show, and then limited partners are the foreign investors. But generally speaking, we don't use this as much. And I'll jump to the two that we do use. Corporations. Corporations are the most common form historically of getting a group of people together on a common business enterprise. It's governed by RCW 23B. Corporations are a distinct entity. They're perpetual. You have to register. You have articles of incorporation. You have to be very transparent about the number of shares, the classes of shares, the series of shares. You can have different voting rights. You can have different rights to dividends. Shareholders do not have personal liability, but at the same time, they cannot be involved in the management of the corporation. If they get involved in the management of the corporation, then what will happen is it's called piercing the corporate veil. They'll say, this is a sham, you're not a shareholder, you're actually a director, and then you have some liability. In a corporation, you have a lot more compliance. You have formal meetings, you have boards of directors, you have officers, you have your shareholders. If you are a small business owner, I would shy away from having a corporate structure. It's a lot of extra paperwork that you don't really need to have. If it's just you or two other people or one other person, a limited liability company is a lot better. If you're a small tech startup or a company where you're going to take on a lot of investors or you have people playing a lot of different roles, corporate structure might make more sense. For maintenance, every year you have to file an annual report, pay fees. You have your board of director meetings where you appoint officers, so that officers are president, vice president, treasurer, secretary. You can have committees to take on particular projects or service areas. You have your shareholders meetings where you elect board of directors, corporate minutes, resolutions. If you've ever come to a city council meeting, very formalized, just like that. So it's not really the ideal structure if you're a small business owner. It's a lot of work. If you do a corporation, you experience what's called double taxation. So when the corporation generates revenue, it's taxed as a distinct corporate entity. When you take your dividends, you get taxed for dividends. If you do perform work for the corporation, you get taxed as a W-2 employee. So corporations have a lot more taxation going on involved. And this is why I like LLCs. Limited liability companies are governed by RCW 2515. You register with the Secretary of State. You don't have to have one, but I highly recommend having an operating agreement. Operating agreement, not the kind you download off the internet or that you get from the library. Sit down with an attorney, do a proper operating agreement, because the operating agreement will set out all the rules, and it'll talk about voting rights, power, how you sell, buy-sell agreements, and make it clear. Spend money proactively, setting up your business properly, rather than fighting and litigating, spending 10 times more in litigation costs later because you have misunderstanding. And it'll spare you a lot of headache. So have a good operating agreement. In your name, you have to have LLC or limited liability company in your name, so it's very clear to the public that you are not personally liable. In a limited liability company situation, you're not personally liable. Whatever happens in the company stays in the company. However, on a practical level, when you borrow money, usually banks will want you to sign a personal guarantee. So when you personally guarantee a limited liability company debt, you're on the hook for the debt. But you have shielding from tort liability. That means someone slips and falls on your property, you're not liable. Someone in your business, you have some lawsuit involving goods or services, you are not personally liable. Worst case scenario, you fold the company, you reopen a couple weeks later. Maintenance is very easy. You have an annual report and fee. It's about, I think, $75. You have to retain your records for 3 years. Control, it's very flexible. In your operating agreement, you can say, John Smith is our manager. He has authority to handle majority of transactions. Or you can have management by the members, where let's say you have 4 members. Members are kind of like shareholders, but they're involved. Any major decision, all 4 shareholders have to unanimously agree. Or you can set it up where you say, 75% of the members are required to approve transactions. You can set it up however you like. You can have different classes of members. So you can have your, my time's up. Okay, I'll wrap up. You can have different classes of members where you can have your angel investor group, the people who put up the initial portion of money, where they will get allocated more money faster up front. And then you can have a Class B membership group where they're gonna get a smaller bit because the business is already up and running, a lot of the risk is gone, and they have perhaps less voting power or control. Limited liability companies, very flexible. You can also allocate profit and losses, distributions. You can sell your membership interests, and this is very important. If you're the one who's starting the limited liability company, you want to have control over who's going to be your member, because it's kind of like taking on a spouse or dating. It's a relationship. It's a business relationship, and when money's involved, things get intense. So in our operating agreements, we usually require unanimous consent from the existing members to take on a new member. So if, let's say you had 3 people, one of them, he's retiring and he sells to his son. Son is a pain in the neck and you don't want to do business with him. You do not have, if your operating agreement is properly structured, you don't have to admit that person as a member. They may be entitled to profit and loss share. They may be entitled to access to see the financial records periodically when they prepare the taxes, but you don't have to admit them for management or control. You don't have to deal with them. So that gives you a lot of flexibility. So that's basically it. Those are the common structures. Limited liability companies are very easy to use, easy to set up. You can set one up in about 2 hours' time. Thank you.
Thanks, Dan, very much. It was very informative. Our next speaker is going to be Maria Bogojas. Maria is with a local CPA firm and one of our local experts on QuickBooks. She's going to work with you and explain the ins and outs of QuickBooks and how they can be your friend when you get ready to go speak with your lender and make your business operations run a little bit smoother. Thank you.
Thank you, Doug. Thanks for inviting me back. My name is Marie Bogojas, and I have been working with small businesses, had the pleasure of working with a lot of startups. I'm currently working with Fitch at Benedict & Clark right here in Auburn. For the past 14 years, I had my own consulting practice, and I specialize in QuickBooks. And I also teach at Green River Community College, where I teach a class that specializes in small businesses using the QuickBooks software. So over the course of these years, I've learned a lot of different things, of things from my clients about good ways to do things and some not so good ways to do things. So with trial and error, we've had a lot of growth with QuickBooks, a lot of exposure, so we know workarounds. And one of the things that I really wanted to focus on today was helping the small business owner get the financial statements out of their software that they need to in order to either start their business or to expand it. So when Mike comes up to speak, he'll be talking in more detail about the specific documents. So two things I wanted to kind of separate this into is planning for success and also planning for growth. So in the starting of your business, you want to plan to succeed. So you want to set up the tools. And like I said, I specialize in QuickBooks. But one of the things you want to make sure is, what kind of business are you starting? Are you starting a service business where you're going to invoice your clients and then collect payments later? Or are you going to start a retail business where you're going to have inventory, you're going to have people coming into your store, you're going to probably need a point of sale system, and you're going to have to track inventory. Those things are very important. So one of the things you want to make sure when you're starting up, or if you're running into difficulties and trying to get through these, if you need to shift your software or restructure it, you want to make sure that if you do need a point of sale system, make sure it integrates with the software you're using. There's a lot of companies out there that I recognize specifically because they say, oh, we're QuickBooks friendly. We integrate with QuickBooks. But sometimes it's not really a good integration. So you really want to research that if you're going to need that inventory and point of sale information. Oops. Okay, so like I said, QuickBooks is used by 92% of the businesses, small businesses in the United States. If this is something that you want to use, of course, I strongly recommend it. There's a lot of support out there for QuickBooks. And when it comes to explaining and being user-friendly, this is one of the best out there. When you pick a software, you want to make sure that it is going to be able to generate the transactions that you're going to use. So if you're going to have a retail business, you're going to have daily sales, you want to make sure your software and your point of sale is going to be able to capture that daily sales information. At the end of the day, you know, all the different categories that you sold products, how much did you collect in cash, credit cards, and so forth. Once again, you want to make sure all of your hardware and software is compatible. If not, you can run into a lot of problems. So you want to have an accounting software, a point of sale software, and also make sure if you have a credit card processing company, make sure everything integrates together to make your life easier. You also want to know what kind of other transactions do I have. If I'm billing out customers' invoices, then I'm going to be receiving payments. You need something that can efficiently process that. As far as handling your outgoing payables, you also want to make sure that you have everything set up properly, that your accounting system can take care of that. And if you're not going to run the business by yourself, you're going to hire employees. And that goes into a whole nother consideration as far as software, reporting, and so forth. Okay, one of the things that I've run into, there's so many people out there that are really good at their trade, but they actually don't know business itself very well. So is what I always recommend to people is do your research. Don't only know your business, but know business in general. I've seen quite a few people fail at their businesses because they get frustrated with their employer. They decided, you know what, I'm going to go out and start my own business. But really, they don't really have the knowledge to do that. So you want to make sure that you have that background, and also make sure that you understand how to read your own financial statements. Once you get started, you have some software, it starts generating these reports, you need to know what they are, and you need to know what they mean and how to read them. Because when you take them to the banker, they're going to go, wow, you know, and you're going to be kind of scared going, is that good or bad? You know. So you want to understand, what's the difference between a balance sheet? What's the difference between an income statement, a cash flow statement, general ledger, subsidiary ledgers? You want to make sure you're reporting and calculating sales tax correctly if you're selling retail products. I've seen so many people get caught on that. You also want to make sure you have very accurate reporting of payroll and payroll taxes. And then you have your budgets. You want to make sure that you have all those that look very clean and they all tie in together. Because for an accountant or a banker, when we look at financial statements, we can instantly look at the two of them and say something's wrong. Because there's numbers on the different reports that should tie in together, and if they don't, we automatically know that there's a problem. So now that's kind of starting up and planning for your success, and then a few things for planning for your growth. So you get started up and you're doing really well, and you know that down the road you want to expand your business. So one of the things that you want to do as far as planning for your growth is your funding. You want to establish a strong relationship with a banker or a lender that you can do business not only with right now, but also that they're going to be able to help you in the future when it comes time to say, okay, I'm ready to expand. I need a line of credit or a loan. And how much do you need? You need to know how to do some forecasting for your future needs. I've seen some small businesses, they say, you know what, I'm going to set up an account with my credit union because they're really nice and I like them and their fees are really low. Well, you got to be careful and do your research. I've seen some businesses do that, then they find out, well, credit unions or some credit unions, for example, don't do payroll taxes. They don't do certain things for businesses that you need. So you want to be careful that, do your research, make sure that that lender is going to be able to service your business throughout the life of your business, not just now, but later too. Your credit. You want to make sure, especially if you're a new business, establish a credit in your company's name, not in your personal name. And a lot of people don't realize that there's a difference. You want to make sure that your company name starts establishing some strong credit and a credit rating. You want to be able to frequently monitor that credit rating. And then a lender or some credit counselors, they can advise you on different ways to help build your credit score up. You can go to your banker, a couple years before you're ready to borrow and say, what credit score do you like to see? What kind of reports do you like to see? Know these things up front. And then you can be proactive. You can set up your company and your accounting system so that when you're ready for that loan, you have everything ready to go. Your financials. Like I said, do you know how to read and interpret your financials? What's the difference between a balance sheet and an income statement? Well, that's a really quick little accounting lesson that a lot of people don't know. A balance sheet is exactly what you own, what you owe, and what your company's worth on a certain day. It's a snapshot. It has one date on it. Whereas a profit and loss statement, it covers a span of time. It always has a beginning date and an end date. It might say, the year, for the month, but it's a span of time. The other difference is the balance sheet, it's all registers, like your checkbook. They keep rolling forward. From year to year, you keep the same registers. Whereas a profit and loss statement, when you get to the end of your fiscal year or your calendar year, everything goes to zero and starts over. So that's one of the main things that I see small business startups, they don't understand the relationship between those two and the importance of it. That's why I say when you go to the banker, you want to make sure you know those things. Does cash basis or accrual basis matter when looking for financial statements? Absolutely. When Mike comes up and talks, he's going to talk about how he only wants to see accrual basis. What's accrual versus accounting? Accrual versus cash. Well, cash basis accounting is when you record your income when you get paid, the day the cash changes hands. And the expenses are recorded the day you pay the bills. Accrual basis is based on document dates. It's document date driven, so the date on that bill that you get is the date you record the expense. The date on the invoice you give to your customer is the date you record that income, even if they haven't paid it yet. And that's what the banking industry wants to see. It may be different for like Department of Revenue, but you need to know the difference between those and plan for it. Do I know how to audit-proof my business? Okay, when it comes to what I say audit-proof your business, this is really all about keeping proper documentation. So you want to make sure you keep a good accounting records. You want to make sure that if you have purchased some fixed assets for your business and you get that one of those receipts on that thermal paper, okay, you better go photocopy it or scan it on your computer, because by the time you get audited, that piece of paper is going to be blank and you won't have any proof of what you're trying to show the auditor. The reason I bring up auditing is because those documents support all your financial statements. And those are also items that bankers will likely want to see. What professional advice should I seek when I'm starting my business? These are a few slides that I brought in that were actually from my last presentation on starting up, but I thought that they probably could help, kind of further on our discussion today. You want to make sure that if you know ahead of time you're going to plan on expanding, get some advice now. Find out what you're going to need. Don't wait for it to be a surprise. So if you need to go see an attorney, see an attorney. If you need to see a financial planner, great. If you need to go an accountant, I can help you. So suggestions, like I said, be proactive. Research your industry. Know what you're going to need to succeed. Okay? And like I said before, know business, not just your business. Identify your own strengths and weaknesses, because if there's some task that you need to accomplish in your business and you don't like to do that, you're not probably going to do very well at it and you won't want to. Delegate it to somebody else that can help you out with that. Just develop smooth procedures. Organize your tasks within your business. So if you're gone one day, an employee can pick it up and say, okay, here's what we're supposed to do when the boss is gone. And most of all, you want to make sure you're having fun at your business. If your business is running your life and you're not having fun at it, then something's wrong. You want to make sure this is your passion and you want to make sure it's working successful for you. So I hope that was some helpful information, and we'll be doing some Q&A at the end, so if you have any questions, I'll be glad to answer them. Thank you.
Thank you, Maria. That was absolutely wonderful. At this time, Michael Miller, Senior Vice President with Umpqua Bank, Relationships Manager. Mike's going to talk to you about the world of conventional lending. Thank you.
So I got 20 minutes? Yeah. Okay. So first of all, I want to commend all you people for owning a business, because it takes a lot of guts to own a business. I tried it. I couldn't do it, so I went back to be a banker. So bankers love to give advice, as you probably know. So keep up the good work, and don't wake up in the morning, a day of payroll, going, how am I going to do that? Because that's one thing that scares people. So bankers, I've been doing this for 33 years as a banker. So they haven't fired me yet, so I must be doing something right, I figured. So let's go to the first slide. The first slide is called the 5 C's of credit. These are very important. I know that's small up there, but if you read it, we look on each one of these C's when we evaluate your business plan, evaluate how you're doing. Each one of these C's are very important. Keep in mind, you need to have all the 5 C's. If you're missing a C, don't think SBA is going to be able to shore you up because you're missing a C. SBA is there to help us bankers and your business people to help with a weakness, not with something that isn't there. So always remember, and the biggest one, of course, is the capacity. We're always looking at that. How are you going to pay the loan back? We really only ask you 3 questions. How much do you want to borrow? What are you going to use the funds for? Because you can't use it for illegal purposes. And I should ask, is anybody in here in the marijuana thing or anything good? That's a very hot subject right now with banking and what we can do and can't do. And then the last thing is, how are you going to pay me back? That's what I really want to know. And that's what takes that ream of paper that you end up bringing these big packages into us. It's how are you going to pay me back? So we look at historical, but if you don't have historical, then we look at your projections. Capital. You have to have capital. You can't start a company on a credit card. You can't start a company on blood, sweat, and tears. You need to put money into your company. If you're not going to do it, it's going to be hard for you to go to a bank and ask them to assume risk of which you don't even have capital into it at that time. Collateral, not all the times you need it, but most of the time you will. It has to be something that you can pledge, something that you can use in case you cannot pay the bank back. It is what we call our secondary source. Conditions are basically, what are you asking for? A term loan, and we'll talk more about conditions coming up here, because the bank only does 2 types of loan, a short-term loan and a long-term loan. And then we have character. Character is important. Character loans, even though they were told we don't do them anymore, we do. We gauge your character by your credit report, by the way you conduct business, the way you pay your vendors. All these things, the way you pay your taxes. If you're not paying your taxes, why do you think a bank would lend to you? The bank is there to help you, but not there to bail you out, which is what a lot of people would love to see. So next slide. So basically, we're just going to talk a little bit about types of bank financing and how to apply for one, and then I have some rules of thumbs for you. So bank financing. Next slide, please. Banks lend capital to profitable businesses for the purpose of acquiring long-term assets or to help them grow, as Maria said. All those words are important there. We lend capital, which is funds, money, to profitable businesses. Businesses that can demonstrate they can pay us back. For the purpose of acquiring equipment, a building, or the purpose of growing, which would be maybe a line of credit to help them bridge the timing gap between when you sell your product to when you collect on your product. Banks are answerable to their stockholders. I know you think that sometimes we're part of the government and that we should be helping the public, but we're really a private industry that has stockholders. Every time I don't make a good loan, I lose money for the bank. It's like I took it out of somebody's pocket. But that's the way we look at it. The stockholders are looking for us to do a return that is profitable. The conventional bank loans are two types, as I said, short-term or long-term. And you will have to personally guarantee it. Anybody who owns more than 20% of a company will be asked to guarantee it. So we do, as Dan said, we pierce that corporate veil and we put you on the line. But think about it in being in my seat. If you're not willing to guarantee your own company that you started, that you firmly believe in, why would you think the bank wouldn't start thinking that maybe you don't believe in your company as much as we think you do? So a personal guarantee is out there. It's not beautiful. Don't read the writing because it'll probably scare you to death, but it's there. It's really showing us that you believe in your company, and that's what we're looking for at the bank. So let's talk about short-term loans. Short-term loans are very simple. By definition in accounting, a short-term loan is any loan that will be paid back within a 12-month period. Usually the interest is monthly, and your principal is at maturity. A line of credit or a bullet loan, we used to call them. And they got the name bullet for a reason. So a bullet loan, basically, you borrow the money, and you said, I'm going to pay you back when I collect the money from Joe. So lines of credits were developed from bullet loans. We used to do a lot of them. Give you a simple note, single note, 30-day, 45-day note, and then you paid us back. Well, companies kept coming back, so we decided to start the line of credits. What you're leveraging is your short-term assets for short-term needs. Don't use a line of credit to buy a piece of equipment. That is a mismatch of your funding with what you got. We expect to have that short-term loan paid back in 12 months. It might take you 5 to 7 years to pay back on a piece of equipment. You pay me my short-term loan back through cash flow, which means that you're collecting money from somebody, I'm helping you pay the vendor for the cost of goods, and you pay me back when you collect from the customer. Long-term loans are paid through profit or cash flow. It's what you make at the end, not what you're making up at the top. So usually short-term assets we use, accounts receivable, inventory, those are pretty much. Or we'll do a cash secured loan if you'd like. Doesn't make quite sense to use your own cash to borrow my money at a rate. So the rates are variable. You heard about prime. Prime is what we lend to our basic best customer. And prime right now is at 3.25. I don't think it'll go down. It has gone down. When I started banking, it was at 18.5. That was prime. So we add a spread to that. So people were borrowing short-term money at 20% during those heydays way back about 30 years ago. As I say, the term is less than 12 months. Your collateral is usually short-term, AR's inventory. You have to pay a fee. I'm sorry, but that's how I make my money, is I collect fees too. So a fee is usually 1%. If you're continuously using a line of credit, then that fee could drop to 0.5% or 0.25% when we renew the line of credit at the annual review date. Okay, let's do long-term. Long-term is really what a lot of people probably need. Long-term funds are used to purchase long-term assets. Payback period is more than 12 months. And this is where we start having you make a monthly payment and an interest payment. So P&I, we call it principal and interest monthly. Now, it doesn't have to be monthly. It can be quarterly. It can be at certain time periods. It depends on your seasonality. And be very careful. Some banks like the standard monthly one, but if you are, let's say you're a Christmas tree farm, and you sell Christmas trees in September, October, to collect in November, it makes no sense for you to make a payment for 12 months or 11 months when it's that 1 month at the end that you get your money. Because all you'll be doing is borrowing money to try to make your payment. So even though we say it's a monthly payment, it doesn't have to necessarily be every month. It can be quarterly. I used to have a tourist company, and their heyday was May, June, July. And we would only have them with annual payments on their term loan because it made sense to do it that way. Equipment term loans, we're going to break equipment loan. Long-term loans are breaking up into basically two categories. There's a third we'll talk about a little bit. First category is to buy equipment. The second category is to buy real estate. The third category is what we call the SBA working capital loan, which is really to build working capital so you can grow. So on equipment loans, the period not to exceed 5 or 7 years. Now, if you can go longer, if you want to use an SBA program, they'll go up to 10 years on equipment. But keep in mind, every year you add to that amortization, the lower your payment gets. Try to get the lowest payment you can, because you can always pay that loan off early. But if you have to go back and borrow money to make a payment, it doesn't make sense. Rate. We fix the rate for 5 years. Almost every bank does that. There are some banks that may go a little bit longer, but we usually do them for 5 years. If you want a longer rate, say 7 or 10, then we use what's called an interest rate swap contract. Now, what we're doing is we're taking a sort of a variable rate and making it a fixed rate for a longer period than what the bank would like to see, or what the bank would like to give to you. But there are penalties for breaking that contract early. Collateral will be your asset that you're buying usually, which is equipment, so you can leverage what you're buying. You don't necessarily need to have equipment to buy equipment. Your down payment, 10 to 20%. Usually with SBA, it's 10. Banks like to see 20. And your debt service coverage. So for every dollar that you borrow, you need to make $1.20 in profit. You need to show us historically that the company can pay the loan back. If it can't, then we work toward an SBA loan or something where we're using your projections to show that. So if you need to rely on projections, be prepared that maybe we may have to bring in a government guarantee program or something, or you really need to be in business for a long time to show that maybe your projections are realistic. Okay, real estate. Basically, it's just a term loan. Not a lot of people can grasp that concept sometimes. Funds are used to purchase an existing building to house the operations of your business. If you are going to buy it for investment purposes, there's a program for it, but it isn't quite as lenient as it is if you're going to be an owner-operated business. Funds can also be used to build a new building to house operations. So we do construction loans and then tie it to a perm takeout. Amortization, 20 to 25 years. You want to go longer, I think SBA will sometimes go 30. Is that true, Mark? Nope, not any longer. We hit this last go-around, too many people went 30. Too many people went under for going 30 years. 30 years is what you get for your personal residence, but you don't really get them on commercial side. Terms, usually we will go for 10 years. So we'll do a 20-year AM, a 10-year call. At the end of the 10th year, your loan has matured. We will be looking at it to renew it. Chances are you've been making your payment on time, you're profitable, everything's working out good. The bank will probably renew it and go another 10 years on it. But it is a chance for either the borrower or the lender to part company and say, okay, we're going to go look around for another bank, or the banker asking you to look around for another bank. Fees are usually about 1%, 1.5%. Again, the down payment's usually 20 or 25. SBA, you could probably do a 10% if you're using the SBA 504 program, or if you're using the 7A program too. So, but keep in mind, the more money you can put down on a long-term asset, the better off you're going to be if the economy starts going sour. The big problem we had last go around was everybody had 10% into their buildings, but the building went down 30% in value. You're underwater immediately. Now, do you give up the assets because you're underwater? I don't know. Some people believe they should. I didn't. I believe you keep gutting it out, and sooner or later, the value will come back, but it won't come back. It'll take a while. This last go around, it took us about 5 to 7 years to get out of it. Company must occupy 51% of the building to consider it an owner-occupied building. If you're only going to take 40% and rent out the rest, you're not truly what we call an owner-operated building. You're more of an investment type building. And sometimes, most of the time, we like to think that you're going to take that other 49% and grow into it in a 5 or 7 year period. Usually that's what we like to think, that you're not overbuilding a big building and you're trying to make rental income off the other 49. What we like to think is that you're going to be expanding and pretty much take the whole building over sooner or later. Your debt service coverage, again, 1.2 means for every dollar you have to pay back, you have to have $1.20 go to the bottom line, known as profit. 2 types of SBA programs you can use are the 7A, or you can use the 504. Those programs are becoming a little bit more diffused now. They used to be very different, both sides, but now I seem to think that the programs are sort of melting together, but they are different. A 7A is where we work with SBA. 504 is where you work with an economic development, or a CDA, they call them, Certified Development Authority. A bond is floated for 40% of the money. You come up with 10, the bank comes up with 50. That 40% bond is usually carries a 20-year fixed rate, which is nice. But remember, there's a huge penalty for the first 10 years if you try to break that bond. The bank's portion will usually be what I say is, usually will be like a standard real estate loan. 20 to 25-year AM, 10-year call, rate fixed only for 5 years. So let's talk about a rule of how to apply for a loan. How many people have their business plan done? How many people are going to do a business plan? Yeah, good. Everyone should do a business plan. It's great, especially if you're starting a company. Why would you put your capital, remember you got to put capital in the deal, if you're not going to do a business plan? If you don't want to do the business plan, then I would suggest you take your money, go to Vegas, and put it on 7 Red, because you're probably doing the same type of gambling when you don't do a business plan. For 33 years, I've been looking at business plans. 30 years ago, we didn't even ask for them. SBA's done a great job with SCORE and everybody in getting people to now understand that business plans are here, and they need to be worked. Don't do your business plan and put it in your top drawer and don't do anything with it. Just because the bank wanted it doesn't mean the reason to do a business plan. If you have 3 or 5 years, the business plan isn't quite as important as you could do what we call loan requests. We still want to see components of the business plan, and it's nice to know you've done one and you're actually working it. But you can, because you have 3 years of operations and we get to see your historical, you can probably cut it down so it's not so many pages. What your application has to have is 2 years of financial statements on the operations, along with corporate tax returns if you're using a corporate structure. You can always include other years, especially if they're profitable. The bank is what they're trying to do is look at a trend. We want to see there's a trend going. I like 3 years because 2 years do not make a trend. If you have 1 up and 1 down and 1 up, then I can see that it's going like this. If I have 1 down and 2 up, the trend is pretty noticeable. So that's what we're trying to do when we ask for your historicals, just try to see a trend going on. If they're account prepared statements, compiled, there's 3 levels, compiled, reviewed, or an audit. Compiled is one we see the most, and if you're over 10 million in sales, you should probably be doing a review at that point. But you won't have to send us your tax returns if you have an account prepared statement, because Maria's doing her work and making sure it conforms to GAAP and everything. So that's what we want to see. And we want to see it on accrual. We don't want to see it on a tax basis, because your accountant's job is to limit your taxable liability. And that's what a tax return does. So they're going to make a lot of adjustments to your tax return so you pay as little tax as possible. We want to see accrual because it's what they call the matching principle. You're matching your revenue with your expenses. When you don't do it, it really takes it off kilter. And one of my good examples are contractors that work on a completed contract basis. They pay all the expenses in year one, and they collect all the money in year two. Now you can imagine how that statement looks. Big losses in year one, big profit in year two. We like to see how much profit you're making. We like to see that your cost of goods and your gross profit margins are working. And we can only see that through the accrual statement. We'd like to see cash flow projections for the upcoming year, usually monthly. And then we like to see annually for 2 years thereafter. So you don't have to do all 3 years on a monthly basis, but the first year we like to see monthly. That's going to show me your sales cycle. It's going to show me your sales curve. It's going to show me what bills you pay when. And it is a cash flow, so now we're converting back to cash. When do you pay it? Good examples are quarterly taxes. If you try to make them accrual, you would just do them over a monthly basis. We like to see them we like to see when the cash is out, and then we like to see at the bottom what is the biggest deficit you have during that year. Because we know that you're going to make money sometime of the year, you're going to have losses during the other time. Hopefully by the end of the year, you're going to net to a profit. Personal financial statements. We do want to see a financial statement on any owner that owns more than 20% of his company or her company, along with your K-1s. So get used to just getting it ready and putting it in. If you want to bring a partner in and you don't want them to guarantee it, and they don't want to, then I suggest that you keep their limited equity to 10%. And then they may not have to guarantee it. But 20% is a rule for SBA, a rule for us, and a rule for most of the industry. There may be other information needed, depending on what you do. If you're exporting, we can do the export express line of credit. We'll want to see maybe the insurance that you're going to get, if you're going to get for your foreign receivable. We'd like to see, if you're doing construction, I want to see a budget. We want to see who the contractor is. We want to see all that information that you're going to be needing to show us, to show that you can get this building built for what you say it's going to cost to build it. So let's go to the next one. I think I'm almost done. Rule of thumbs. Rule of thumbs are just what they mean. Not everybody uses them. You all have different ones, but if you can stay within this category, you're probably doing pretty good. Company must be profitable and must have been capitalized correctly. I always say that one more than once, only because it is important. Down payment. The bank will want you to have some skin in the game, we call it. So when you go to buy something, we want you to put some money into the deal. That's called your down payment. Equipment 10, real estate 20. But if you have no skin in the game, we don't think that you have any risk associated there. So that's why we want to see some of the skin. So this is why it's important to think about these things up in the future. If you're going to build a building, say the building's going to be $1.4 million, that's $280,000. Now, how many people have that in their savings account right now? None. So you got to start saving for that early. You can't just squirrel away $280,000 out of your operation because it's going to cause you not to have cash. So you got to start working towards saving for that down payment. It's just like you did when you bought your first house. I don't know, you guys probably aren't old enough to remember that one, but we used to have to save. I mean, you used to have to put 20% down. It was mandatory. Things got a little out of whack. Debt coverage, try to show that you're not just breaking even and you're just not, and after you pay your loan back, there's no surplus. You have to have the surplus to take care of unforeseen problems. Every problem that you suffer as a business owner can go back to cost you money, whether it's time or whether it's money out of your pocket. Somewhere down the line, you can always equate it back to a monetary loss you took because you went through the cycle, you didn't know you were supposed to do something, and then somebody tells you you don't pay your taxes on time, you get a penalized. That's money. Think about it. If you paid it on time, you wouldn't have to pay the penalty. So leverage. Leverage is what you do when you want to leverage out something. In other words, like a fulcrum. So 3 to 1. For every dollar you have in your net worth, try to keep your liabilities, total liabilities, which is what you owe everybody else in the world, under $3. That's what leverage means. So for every dollar in your net worth, you have $3 up in liability. If you're out there right now, then you're starting to get what we call highly leveraged. And then you must have working capital. Does anybody know what working capital is? You can't touch it, you can't feel it, you can measure it, but you can't, it's an invisible little thing, but I'll tell you what, the 1st and the 15th of the month become the worst days of the month for you because you don't have it. That's when your phone rings off the hook. That's when everybody's saying, Joe, how you doing today? They don't really want to know how you're doing today. What they want to know is, where's my money? You promised me you'd pay me. So you can always tell you don't have enough working capital if those days of the month become the kind of days that you dread, that you want to stay home. And you can't call in sick because you own the company, remember. Okay, so we're going to talk a little bit about why most small business fail, and then I'll be done here. Lack of good management and accounting system, as Maria said. If you don't know where you're going, you don't know how to get there, how can you go on a trip? Lack of vision, lack of financial planning, over-dependency on specific individuals. This is sort of important because this person is probably not an owner of the company, but he's probably one of your employees. What happens if somebody steals him or her and you have to replace them or you have to assume that job? So you don't want to have somebody who doesn't own your company become the key element in there. Poor marketing, lack of knowledge about the market competition, inadequate capitalization, see that word comes up a lot, absence of standard quality programs, and then owner's concentration on technical rather than strategic work on hand. So the last slide is how to get a hold of people at my bank down in this area. I do live in the area. I don't live in Auburn. I live up on Lake Tapps, but that's close. I will be staying after the meeting, so if you want to talk to me about anything, feel free. I'm not going to go back to work. I'm going to go home. And the people I got here is myself. Britt McAllister does what we call our business banking, so she covers loans between $500,000 to $1 million to $1.5 million. Ruby Elwood is our store manager down here in Auburn off 15th, and she does loans between 0 to 500. And then Mike Esfeld is our SBA government. We call a guy who works with SBA on getting your SBA loan together. That's it.
Thank you very much, Mike. That was very great. Next, we're going to hear from Mark Costello with the SBA, and is going to talk about how they can help you through the process with the world that Mike just explained.
Thanks very much, Doug. Hey, how many of you guys are in business now? Just a show of hands. Okay, great. Thanks. Great. I appreciate the opportunity to be here, Doug, to talk about the Small Business Administration, a little bit generally about what our agency does, but then I want to talk specifically about how we work with lenders to facilitate financing for small businesses, and how we work with banks like Mike's to help people get access to funding that might not otherwise be available. He made the distinction, which was very appropriate, between conventional financing and SBA financing, and there is a difference, but whether we're talking about conventional loans or SBA loans, one of the misnomers out there about SBA loans is that they're made by SBA. The fact of the matter is they're actually made by people like Mike and Umpqua Bank and a variety of other lenders out there that are participants in the SBA program. So I'm going to talk about that, kind of the mechanics behind how the program works, and really what the some of the benefits might be to you guys as potential recipients of funding. So I want to go ahead and talk a little bit just about SBA in general. I want to focus in on what we call the 7A Guaranteed Loan Program, which is kind of the flagship financing program available through SBA and its lending partners. I want to talk a little bit about a couple of other maybe financing options out there, not necessarily specific to SBA, but I think might be worth mentioning for folks that are just kind of trying to understand the landscape of funding for their businesses. I want to talk about some other resources that are out there for you guys available associated with SBA, not specifically talking about financing, but maybe talking more about advisory services and technical assistance. And you'd be surprised to find out that there are some really nice opportunities to get assistance from really high caliber people, and it doesn't have to cost you anything. I'm going to more or less pass on the 5 C's of credit because Mike covered that in depth. And suffice it to say that when our SBA lenders are making their SBA loans, they're looking at the same criteria, whether it's an SBA loan or not. So those things that Mike talked about in terms of capacity and collateral and credit history, all of that still is important in the context of the SBA program. So why don't we go ahead and talk a little bit about SBA in general. We are actually a federal government agency, and I think the thing I simply want to suggest is that we're trying to kind of be a resource portal for small businesses. And so in addition to our financing programs, the 7A and the 504 as well that Mike also alluded to, I think it's important to know that we have partnerships with organizations that do some other things. SCORE, for example, is one that SBA provides funding and support for. SCORE has chapters throughout the country. I think there's 7 here in the state of Washington, and they offer confidential, no-cost, one-on-one business counseling as well as ongoing workshops throughout their chapters here in the state of Washington. The largest chapter is in the Seattle area. It's actually co-located with our office in the Belltown area. So keep that in mind. If you're looking for somebody to maybe take a look at your plan, give you some objective feedback as far as your particular idea or the direction that you're trying to take your business, this would be a great opportunity. The Small Business Development Center Network is another sort of similar opportunity out there. SBA provides half of the funding for this network of basically paid professional business advisors that are located throughout the state of Washington. There are 25 different centers out and around. There's one here in Kent. There's a guy named Kirk Davis up at Highline Community College. There are actually a couple of gentlemen there that are doing the same kind of thing. These are folks that are well-versed in business, well-versed in academics as well, and they have the ability to sit down with people, address business challenges, help to formulate financing proposals, and any number of other services are available through the Small Business Development Center. So either SCORE or Small Business Development Center contact information is going to be accessible through our website, sba.gov/WA is actually the page for my office. And finally, if you are interested in expanding your business by doing business with the government, there is a significant amount of opportunity available out there, and SBA is a great place to go kind of to get steered in the right direction. We have a couple of specific programs that we oversee, but I think we're also able to offer guidance for people who are trying to get exposure to the federal government and the state government, all the different opportunities that exist out there for doing business with the government. So keep SBA in mind in that regard as well. Go ahead. So a little bit about this 7A loan program. So this is kind of, when you hear of SBA loans, this is more than likely what we're talking about here. So the 7A guaranteed loan program essentially is a vehicle where the Small Business Administration is providing guarantee on loans made by authorized participating lenders. Here in the state of Washington, if you look at the activity last year, there were probably 90 different lenders that participated in this 7A guaranteed loan program, meaning that they made at least one SBA guaranteed loan. So if you can think of a lender that is actively doing small business lending, the odds are really good that they're going to be authorized to participate in the SBA loan program. So I think that it's important to kind of understand where SBA's 7A program sort of sits, what we're trying to accomplish with it. Mike talked about conventional loans, and I would sort of see them as maybe over on the right-hand side of a financing continuum. The SBA loan program might be a little bit over to the left. What we're really trying to do with SBA loans is expand the horizons for you as small business owners and for our participating lenders in terms of the kinds of deals that they can actually put together. So why don't we go ahead and talk a little bit specifically about how that works. We actually guarantee up to as much as 85% of the amount of an SBA loan made through one of these participating lenders. And ultimately, like an insurance policy, like an FHA guarantee or a VA loan, we are mitigating risk for that participating lender. And as a result, we're hopefully allowing you guys as small business loan recipients to receive financing that is going to be on terms and under conditions that wouldn't otherwise be available. You may be able to go out and get, for example, financing for a piece of equipment without an SBA guarantee, but it might be on terms that are going to be particularly onerous for your growing small business. And so that's where SBA kind of steps in and bridges the gap between where your needs are and where that particular offering from the conventional commercial loan side is. We kind of can help that conventional lender get a little bit closer to what your actual needs are. So what are some of the kind of cases that really fit within the confines of the SBA program? What situations would sort of lead somebody to think in terms of SBA? I've kind of tried to identify 5 or 6 things here, and the odds are pretty good that most of you, if you're not there right now, when you do put your business together, you might be in one of these areas. But for example, a startup business, a new business that doesn't have a history of earnings, has a built-in challenge in trying to convince a lender that they have the ability to repay their debt. But you may have a particularly strong and compelling proposal. You may have great experience. You may have a great down payment going into the deal. You may have an outstanding business plan, and it might be something then ultimately somebody like Mike, he might start salivating over, even though it is a startup business, and his eyes will light up and he'll think, you know what, if we brought an SBA guarantee into this, I'm going to be able to get it past my credit administrators and I'm going to be able to get approval on this deal. And that's kind of what we're trying to do here. Other things that might present sort of unacceptable risks for a lender who's trying to do a conventional loan would be inadequacy of collateral. The vast majority of all the SBA loans that get done are not fully secured. A lot of the businesses that get SBA financing are service and retail type businesses that they might have intangible assets or intangible value. They might have inventory and fixtures and things like that. But ultimately, lenders recognize that isn't going to have a lot of value if they had to liquidate. But what they can do is bring in that SBA guarantee again to reduce the risk of that inadequate collateral, and it allows them to kind of leverage the real strengths of the deal. Maybe it's historical earnings, maybe it's your background, maybe it's a strong capital position in the business, maybe it's a great position relative to the market. Using the SBA guarantee allows lenders then to kind of overcome what might otherwise be an insurmountable weakness. Other situations, and this is one that's kind of subtle, but it's very common. You as a new or growing small business, you're generally going to be looking to extend out your payback period on your financing as much as possible. The conventional lenders are generally going to be looking to collect their loan as quickly as possible. So there's a little bit of a conflict there. The SBA guarantee kind of, again, bridges that gap. So by providing that backing to the bank, they can get comfortable with things like a 10-year maturity on an equipment loan or a 25-year fully amortizing arrangement for a commercial real estate deal. Or maybe you're somebody who's looking to go buy a business and it's got intangible assets that can typically be structured with an SBA guarantee over 10 years. And those are terms that you're more than likely not going to be able to receive if you're seeking conventional financing. So it's going to allow you to get set up in maybe an optimal situation as far as the prospects for financial health going forward. Other cases might be that you simply don't have a 30 or 40% down payment going into a deal, whether we're talking about commercial real estate. Mike talked about maybe a 10 or 20% could be possible with SBA, and that is true. Maybe you're going looking to buy that business and you've only got, I don't know, 10 or 15% to put into the deal. That's going to probably be considered to be highly leveraged. But again, maybe it's a great business. Maybe you've been working in that business. Maybe your seller is going to carry a little bit of the financing. Now you've got a situation where if you bring that SBA guarantee into the deal, a conventional lender can likely get more comfortable with that. So there are a bunch of different situations that might dictate the SBA 7A loan as a solution. A little bit about kind of the nuts and bolts. These loans can actually be for as much as $5 million. There's no minimum SBA loan amount. I think right now the average is maybe $340,000, $350,000, but there are a lot of relatively small SBA transactions being done out there in the marketplace around here in the $50,000, $70,000, $80,000, $100,000 range. There are a lot of lenders that have gotten comfortable with some of the streamlined approaches that we have made available to them, and as such, it's more economical now than maybe it used to be for a lender to do a relatively small loan, and so I think that's a positive thing. A little bit about some of the pricing kinds of issues. SBA loans or lenders are limited in terms of interest rate. Typically, what you're going to be looking at is loans that are priced on a variable rate basis, and it's going to be based on the prime rate. Mike alluded to the current Wall Street Journal prime being about 3.25. So the typical maximum SBA loan rate that you would be looking at is going to be prime plus 2.75 if it's a maturity of 7 years or more. So your current, right now, maximum starting rate on an SBA loan is going to be 6%. Those are going to typically be set up to fluctuate as the base rate changes. So if that prime rate does go up, you're going to want to be considering in your forecasting and your planning what that's going to do to your monthly payment. But right now, we're still at a historically low level there. There is what we call a guarantee fee associated with SBA financing, and it's going to range between 2 and 3.5% of the guaranteed portion of the SBA loan, and that is typically financed, and I think the good news is that it is used to help pay for the program. So that's a positive. I think the nice thing about the 7A loan program, maybe as opposed to some other programs out there like the 504, which is more specific for commercial real estate or heavy equipment, the 7A program is pretty versatile in that it can probably meet the needs of businesses at all stages of the life cycle. So a startup who's looking for working capital, maybe fixtures and some furnishings, that could be done with an SBA loan. An expanding business that's maybe looking to acquire a facility or maybe a new line of equipment, that could be done with an SBA loan. Maybe it's a business that's been carrying some particularly expensive debt on the books for a number of years. That could potentially be refinanced with an SBA loan. Maybe you're somebody that's either looking to go into business by buying a business, or you're looking to expand your business by acquiring another business, or maybe you have a partner that wants to get out of your arrangement and you have an opportunity to buy that person out. Those things could all potentially be accomplished with SBA loans as well, and it can be a nice fit when we're talking about business acquisition, because again, we're oftentimes dealing with intangible assets that will typically present a challenge in terms of the collateral that's going to be available. But again, by bringing in that SBA guarantee, if the proposal makes sense, there's going to be an opportunity there to put those kinds of deals together. And we are seeing, I think, maybe driven somewhat by the demographics out there with the aging baby boomers and so on, we are seeing, I think, more and more lenders that are getting pretty adept at financing these change of ownerships with SBA loans. And I see that as a positive thing. So I don't know if you can see this, but this slide was really just intended to give you guys a flavor of some of the different kinds of businesses looking back at fiscal year 2014 that were recipients of SBA financing. You see that there's a considerable amount of hospitality types of businesses. So the the classic restaurant deal actually does get financed occasionally. But we see a lot of other kinds of businesses as well. I think if you look at some of the trending areas, businesses that maybe have a little bit more of a technology orientation are getting more and more traction as far as SBA financing. In the last couple of years, certainly businesses related to the construction sector have also been pretty significant beneficiaries of SBA financing. But it really runs the gamut as long as it's sort of something that's legal and all of that and doesn't have anything to do with medical or retail marijuana, we're going to be in pretty good shape. We have a problem with that because we're a federal government agency, and so we have this conflict still where we just can't get involved in that stuff yet. So maybe sometime, maybe someday. A little bit about eligibility for SBA financing, not much. I don't want to go into a lot of detail here, but these loans are available to businesses that would be classified as small businesses, and I think everybody in the room is going to probably fit that. The nature of the business is important. Mike alluded to the idea of owner-occupied real estate. Occasionally we'll get involved with or discussions with people that are looking to maybe do something more development oriented. They want to build a strip mall and lease that out. That is not going to be permissible with SBA financing. The idea with our program is if somebody were to build a facility, they need to occupy the majority of the space. If it's a new facility, it would actually be 60%. So there are certain kinds of things that are not going to be eligible, but most typical businesses and business models are going to work. We also take a look at the character of the individual. We have a thing where we're interested in sort of whether or not there's any deep criminal history, and we ask for a little bit of input on that. Occasionally that comes up, but most of the time it's something that we're able to work through. And something called credit elsewhere, what we typically look for is for bankers, again, like Mike. I keep talking about Mike, but he's the only banker on the panel. What am I going to do? So bankers like Mike, we want them to say that in their opinion, the financing that is being requested under this SBA deal is not available if they didn't have the SBA guarantee. So just that we're utilizing the program efficiently, and everybody has really considered all of the different options and that this is the best fit. So a little bit about the process. I think I'm probably starting to get close to running out of time. So again, it's important to just be aware that the program is delivered through this network of really outstanding participating lenders. We've got another lender here, Dave McRae, in the room with Banner Bank, and they are another excellent SBA lending source. But the idea with our program is there isn't a real magical process for getting an SBA loan. What you want to do is identify the lender of your choice. And by the way, if you're having difficulty with that, I'm happy to sit down and talk with you about some of the lending institutions that are out there that might make sense for you. But you're going to identify the lender of your choice. You're going to make application to that lender in the same way that they would have you apply for any other business loan. And what we want to see happen, or what we hope happens, is they are going to take a look at your proposal, and they're going to determine whether or not they want to work with you, and from there, whether or not they would need the SBA to guarantee the loan in order to provide the financing. So you're going to provide the lender the same kinds of materials and documentation that Mike alluded to. all of the things that are going to be required for them to make a good, reasoned decision as far as your loan request, all of the financials and maybe the business plan or financing proposal, resumes, tax returns, all that fun stuff. It's the same whether it's an SBA loan or not. The bank then is going to kind of run with the SBA piece. They will make application to SBA on your behalf through SBA processes and with SBA specific forms and so on. And then they will get a commitment from SBA that says, hey, we'll guarantee the loan under the following terms and conditions. And if the bank goes ahead and closes the loan the way that we all agreed, and they handle the loan in a reasonable fashion, you'll probably never hear of SBA again, and that'll be that. But if it should happen that a loan goes into default, that's where the lender then has the responsibility to do the best they can to collect on the loan. And then they have this contract with SBA that says, okay, we've done everything we can to collect on this deal. Please honor our guarantee. And then what happens at that point is SBA actually pays the bank the guaranteed portion of the remaining balance on the loan. So that's just a little bit about the mechanics there. But the bottom line, I think, is it's about finding a lender that's going to be a good fit for you. It would kind of make sense to me for if I was out there looking for a good relationship. I'd be interested in knowing whether or not that bank or credit union or financial institution had some aptitude as far as SBA lending. If I'm starting a business or I have a relatively new business, more than likely that's the kind of loan that I'm going to be getting. So this is just our quick reference to our loan guarantee programs, and really without getting into the weeds, all it really tries to do is give a flavor of the different sort of sub-programs under the SBA guarantee umbrella. So the fact of the matter is, for example, that we can guarantee short-term financing with the SBA program under what we call the SBA Express program. You have the ability to get lines of credit up to $350,000, and then we also have something called the CAP lines program, which would allow a lender to get a full guarantee on a line of credit up to as much as $5 million. So there are a lot of different kind of sub-programs, if you will, as far as SBA financing, but the essence is the same. We're providing a guarantee, hopefully allowing our lending partner to provide financing that they wouldn't otherwise be able to make available. A couple of other areas or a couple of other noteworthy things is right now, for example, we have a waiver of the guarantee fee on loans up to $150,000. So if you're somebody who's looking for a loan in that range, you have an opportunity for the remainder at least of 2015 to get savings on that SBA deal. If you happen to be a veteran or have a business that's owned by a veteran or a spouse of a veteran, there are also fee savings opportunities. We have something called the Veterans Advantage, which would allow somebody who's getting an SBA loan up to $350,000 under one of our streamlined approaches, which we call the SBA Express, to have a complete waiver of the SBA guarantee fee. If you're a veteran or a spouse of a veteran and you own a small business that's applying for an SBA loan, you have an opportunity for a 50% waiver of your guarantee fee for loans over $350,000. And I can tell you those can be significant if you get into that $500,000 or $1 million or $1.5 million or $2 million range. The SBA guarantee fee gets fairly lofty. It's finance, but it is a lot of money, and so the opportunity to be able to provide that kind of a feature for the veteran community is pretty cool, and we haven't really been able to do anything like that up until about 1.5 years ago. So it's been kind of a neat thing. Feel pretty good about it. So we're skipping the 5 C's of credit, and we're really coming to a wrap up. What I wanted to do finally was simply say that SBA, 7A loans, 504 loans, conventional loans, they're part of this kind of continuum of financing options out there, but there are other options. And so I would just bring that to your attention. For example, we have something called the SBA microloan program, and that is, I think, mentioned on that matrix. There are a couple different organizations that make these SBA microloans up to $50,000. Basically, it's money that SBA has lent to these organizations. They in turn relend it. It's going to be higher priced money, but it's going to be funding that might not otherwise be available even under the 7A program. A couple of other, or a couple of organizations that make that program work and deliver it on behalf of SBA. There's one called Community Capital Development that services this area. There's also Mercy Corps Northwest is an approved SBA microlender, and they're trying to get pretty aggressive, not aggressive, but they're really getting out there and trying to make this kind of funding available. And then finally, there's an interesting organization if you're kind of starting your business. Maybe it's the kind of business where you're interacting with your customers, retail, restaurant, food-related, service-related, maybe fitness-related, the kind of thing where you would have a network developing. There's an interesting organization out there called Community Sourced Capital, and we've been doing just a little bit of kind of a road show with them lately, and what they offer is sort of a hybrid of a sort of a Kickstarter type of a platform, but it's also debt. It's money that you would actually pay back to your community, but they facilitate this. And it's money that is borrowed, but there's no interest rate associated with it. And they typically look at projects, I think, between $5,000 and $50,000. So community-sourced capital is an interesting example, I think, of some of the opportunities that are starting to evolve out there when you look at the internet and all of that. You hear about all this different stuff. Well, these guys have actually done some projects, and you can find out about how they do it and what it's going to cost you, and it could be an effective option. So don't be discouraged if, for example, a 7A loan or a conventional loan doesn't look like it's going to happen right now. There are some other opportunities out there. So with that, I want to thank Doug and thank you folks for your attention today.
Thank you, Mark. We're going to take a few minutes. I'm going to ask our presenters to hit their on buttons for their microphones here and take a few question and answer opportunities. Barb has a microphone here, so if we have any burning questions out in the audience, please raise your hand.
Hi, my name is Surinder Kalo with Better Properties Kent. I had a question regarding bank funding for tenant improvements. I noticed that SBA guarantees TIs and stuff, so wanted to see whether Umpqua entertains something like that or not.
Again, you're probably talking, because we're coming back to collateral here, where T&Is are soft collateral to us. So we would use the 7A program to do it. But again, it would depend on the building. If it's an investment type building, I don't believe we could get SBA to guarantee that. So are you talking about T&Is for an owner occupied building or?
Tenant occupied.
Pardon?
Tenant occupied?
Tenant occupied, yeah.
So the tenant would be the borrower?
Yes.
Yeah, sure. I mean, that's pretty common, right? If we're talking about somebody who's, I don't know, if
Well, wouldn't it be a
professional
con-
practice facility or something like that,
Like
or
a
a
fitness
restaurant
club
facility?
or like a.
Yeah. We would help them, but they would be, the borrower would probably be the tenant more than the,
Correct, yeah, that's
Building owner.
that's the way I'm kind of hearing it. So the idea would be maybe you could fund tenant improvements, some acquisition of some of their fitness equipment, all of those things, roll it
Yes.
into one deal, and it's probably a 10-year loan.
Yeah.
Yeah,
Okay.
yeah, absolutely.
7A.
Yeah, 7A, yes,
Yeah.
okay. Just curious. Thank you.
Good. Do we have any other
Good
questions
question.
in the audience? We have one up front.
I have a question. I have two questions. Can you speak to a benefit corporation? benefit corporation?
What is are you talking
Oh,
about a
social
social
benefit?
corporation?
I don't know. I have a client that recently incorporated a benefit corporation.
That might be the new social corporation where they're not required to only pursue profit. They can pursue profit and pursue, social development or some social causes. That is new. I haven't done one. I've done traditional nonprofits. But what is your client? Is it like a social services?
It's actually a dating site.
Oh, okay. That sounds like a regular for-profit business to me. Yeah.
Okay. All right. And my other question was about QuickBooks.
Yes.
If you have a client, I have a client that is an internet business that gets paid on PayPal. Is there a way to directly input that information into QuickBooks? Or how would you work that?
I do have a couple clients that are internet businesses like that. We do have the ability to integrate. They do have some downloadable applications, I believe, that you can integrate. There is some tweaking that you have to do to make them talk to each other, but yes, it's possible. And the other thing is, you want to set up the PayPal account as an extra bank account.
At this time, I want to again say thank you to all of our panelists and to Mayor Backus and the Auburn City Council for helping fund this ongoing activity, and our partners within the community, the Auburn Area Chamber of Commerce and the Auburn Downtown Association for helping promote this series of workshops. And thank you very much.